Chapter 17, Problem 6. This problem tests your knowledge of carry a net operating loss, carry forward or carry back. In this case, we're going to carry back. So our company is presented with the following information. In year 1, we had income before tax of $290,000, of which we had a tax rate of 40%. In year 2, we had a income of $210,000, which we had a tax rate of 35%. In year 3, we had a net loss of $420,000 at 35%. So what we have to do in this problem is to do a carryback and come up with an income tax benefit. So we're basically going to amend our tax return and do a carryback and get a refund. So the way to approach this problem is simply line up your years 1, 2, 3. Put in your net taxable income of $290. In year 10, $210. In year 3, $420 as a loss. And start working your loss against your gains, your taxable income. So in year 1, we're going to use up $290,000 of the $420,000 loss. In year 2, we're going to use up the remaining $130,000 of the $420,000 loss. That uses up the full $420,000. The carryback times tax rate is the $290 times 40% equals $116,000. Take the $130,000 loss times 35% equals $45,500. So your total income tax benefit is $161,500. So all you have to do is basically use up all of the $420,000 loss to go back 2 years. If you recall, in the chapter, you're only allowed to go back 2 years before you can go back forward. Your journal entry is simply income tax refund receivable, because we're actually going to get a refund, and income tax benefit, which basically reduces our expenses on the P&L side. The next problem is tests your knowledge of accounting for uncertain tax positions. So it's a little tricky, but let's just review our PowerPoint real quick to learn the theory. So when there are certain uncertain tax positions, meaning companies will take some deductions that might be questioned by a taxing authority, GAAP allows us to recognize that deduction based on uncertainty with a certain guideline that is depicted right here in the PowerPoint. So there's a two-step approach. Step 1, the company first determines if it should recognize any benefits from its tax position. It is more likely than not that it will sustain the tax position after an examination by tax authority. So the step 1 would be to recognize that your tax position could withstand an examination by a taxing authority. Step 2 is measuring that position. The company measures the amount of tax benefit to be recognized in the financial statements. The tax benefit is the largest amount of benefit that is greater than 50% likely of being realized upon ultimate settlement. So it's the amount of benefit that is greater than 50% likely of being realized upon ultimate settlement. In this problem, Hush Sound System took an aggressive tax position on its current year's tax return. The taxing jurisdictions have challenged the deduction claimed in prior years upon examination of returns of other firms in the industry. Hush reported $600,000 in taxable income after the $500,000 deduction in question. So, in other words, they originally had $1,100,000 in taxable income, deducted the $500,000 deduction, which is in question, to come up with $600,000 in taxable income. Hush is subject to a 34% tax rate. Based on careful analysis, management believes that it is more likely than not that the position will be sustained upon examination. The company will assess the following probabilities. Possible estimated outcome. Amount allowed as a tax deduction. The full amount, $500,000, has a 5% probability. $380,000 has a 30% probability, and $300,000 has a 25% probability. So what you do is you have to look at the probabilities from a cumulative point of view. So 5% plus 30% gets us 35%. 35% plus 25% gets us 60%. So cumulatively, the greater than 50% rules comes right at this point, at the 25% probability. So when we add up 5%, 30%, and 25%, we get to the greater than 50% rule, which is stated right here. So $300,000 would be the amount we use to calculate the recognition of the tax position. So the first step is to determine whether management can report any benefit from this tax position. If they cannot recognize any benefit, the $500,000 tax deduction is not recognized. Then taxable income is the full $1,100,000. If none of the deduction is recognized, the income tax expense is 34% on the $1,100,000. However, because it's more likely than not the position will be sustained, the company is allowed to recognize some of the benefit. So based on our 50% cumulative rule, per the chart we just looked at, $300,000 of the benefit would be likely, and therefore we would take $300,000 of the $500,000 deduction, multiply it by the 34% tax rate, and that essentially represents the estimate that we would use. And the tax benefit would be $102,000. Hush multiplies the remaining $200,000, which is the $500,000 deduction minus the $300,000 of the tax position, by the tax rate, and records a $68,000 liability for uncertain tax position. So we create a liability. The $500,000 minus $300,000 equals 200,000 times 34% equals 68,000. It records income tax payable of 204,000, which is the reported taxable income of 600,000 multiplied by 34%. So the income tax is 272,000, the sum of its current income tax of 204 plus the liability of 68,000. In this problem, our company wants to exclude $5,100,000 in income from its current tax return. Income before the exclusion was $8 million. So it wants to be able to exclude $5,100,000 in income. There's no book tax difference. The income tax rate is 40%. So under this problem, our data table shows the file amount is $5,100,000, but the likelihood of that tax will be only 10%. $4,900,000, the likelihood is 35%. Cumulative, we're up to 45%, so we're not quite there yet. At $4,700,000 of that $5,100,000, we believe 25% will be likely, and therefore when we add all these up, we exceed the 50% rules. So the $4,700,000 will be the estimate out of that $5,100,000 that we can exclude. So to work this problem, again, the data table is simply right here in columns A. The likelihood that the tax position will be sustained is in column B. They did the cumulative adding for us. So the $4,700,000 is excluded from a taxable income of $8 million for GAAP purposes. Therefore, we're going to show income before tax of $3,300,000 at a tax rate of 40%, gives us a tax of $1,320,000. Under the GAAP, the $1,320,000 is our income tax expense. On to our tax books. We have the same $8 million income before the exclusion, but the exclusion from income, we're going to take the whole $5,100,000 on our tax return. But as we determine through this process, per our GAAP, for what we're reporting on our financial statements, we've determined we're only going to recognize $4,700,000 of that exclusion. But we're going to take $5,100,000 on our tax return. Therefore, we're going to report less taxable income of $2,900,000, apply the same tax rate, and our tax will be $1,160,000. That becomes our taxes payable. The difference is a tax contingency, which is simply the difference between what we're recognizing per GAAP and what we want to take on our tax return. The difference is $400,000. The $400,000 times 40% is $160,000. That $160,000 is going to be on our balance sheet as a liability, or simply the difference between our income tax expense and our income tax payable is going to be a tax liability of $160,000. That tax liability, if they do allow the whole $5,100,000, will be debited if the authorities accept the $5 million, and then our income tax expense would be credited to get the $160,000 off the books.